in the numerator you have the cash flow or earnings of a company, right? In the denominator you have what? Interest rate, right? And so if that interest rate is, small, right, then those earnings out in the future are worth a lot more. If that interest rate starts going up, then they're worth less. And that's the environment we're in right now. And that's how it cascades right through into how equity valuations are impacted by higher U.S. interest rates. So to that end, let me just run through really quickly why the Fed's raising interest rates. But they're also doing something unusual at the same time, and that is their quantitative tightening. They're actually allowing their balance sheet, which they took from $800 billion up to $4.5 trillion, to begin to roll off. And it's this simultaneous monetary policy tightening, pulling those two levers at the same time, that is interesting and unusual. And then I'm going to add in one more thing. All right, so if we look at what the Fed looks at, this is GDPs for four areas of the world. The red is China. You can just kind of see how it's flatlining at about 6.5%. The white is the US. The last number was 4.2. Today's 3.5%. That's pretty robust growth. Look at the last two ones are China and the EU. And they're kind of bumping along, 0.5, 0.7. This is on a quarterly basis. So you can see significantly there's a difference, obviously, between the United States and the EU and Japan. And this is one of the reasons why the Fed's tightening the way they are. Again, with the 3.5% GDP number that we had today, this is the strongest growth we've had since 2014. Another area where the Fed is vindicated, I would say, for raising interest rates and tightening is, of course, on inflation. In the United States, this shows the top line is blue, is the US, the red line is the EU, and the green line is Japan. You can see that since really 2017 and really going all the way back to January 2016, we've seen inflation start to go up. So if you're looking at two very simple ways of looking at economic growth and monetary policy, GDP and inflation are pretty two good areas to look at. And of course, if we toss in U.S. unemployment, that's been below 4% for some time now, and really indicates that the employment situation in the United States is very robust. As a matter of fact, people need workers with skill sets. That's one of the constant responses we see in surveys about the U.S. employment situation. So there's definitely reasons why the Fed should be doing what they're doing. This is what I was alluding to before when I talked about central bank balance sheets, right? And the blue line is the United States. The green line in the middle is the EU. Is that right? The EU? Let me see. No, the green line is the Bank of Japan. Sorry, the red line is the EU. And you can see those central bank balance sheets have shot way up, right? So everybody's been doing this globally. But at the very end there, you'll notice what's happening. The blue line's going down a little bit. The reason why this is significant is because a year ago, back in October, the Fed told us that they were going to begin quantitative tightening. And what they're doing is that they slowly ramped up the number of securities that are rolling off their balance sheet on a monthly basis. They started slow, but now they're at their peak amount. They're going to continue to do this. So $50 billion worth of securities is rolling off the Fed's balance sheet, reducing the balance sheet every month. $30 billion of which are U.S. Treasury securities. So you're putting supply back into the market, right? And if nothing else changed, right, if you get more supply, kind of economics 101, typically the price goes down, yields go up when it comes to interest rates, right? But that's not all that's going on. The U.S. Treasury is actually issuing a lot more securities. And the reason is because of we're running a very large budget deficit here in the United States. So think about this. Put this in your mind for a second. The Fed is raising interest rates. They're quantitative tightening. They're telling us in the future they're going to continue to do this. And the Treasury is putting a lot more securities onto the market. It is no surprise that we've seen U.S. interest rates go up rapidly in a very short period of time. And that's adding to the volatility that's happening in the financial markets. because we don't know how far this is going to go. We're not sure what this looks like. We haven't been in an interest rate higher or hiking regime since 2003, really? There are people that are trading in the financial markets that have never experienced a Fed tightening. Think about that for a second. For all the, you think about all the young traders in the fixed income markets, some of them have come in at a time where they've never seen this before. And that's a little, that creates a little uncertainty out there, right? So this kind of develops this theme. So with that in mind, one of the things I just want to talk about, I'm going to get this is going to get a little technical, but I just want to talk about expectations a little bit. What this slide is it shows the US 2-year Treasury note yield in red, right? And it shows you on the blue line what the Fed is telling us what they're going to do with interest rates in the future. Why does this matter? It matters because at the beginning of 2018, or if we go back to the end of 2017, the Fed was telling the markets they were going to continue to raise rates. But as we entered 2018, you can see that the market wasn't taking it seriously. It thought, we're judging where the 2-year note rate should be, and it's so much further below where the Fed is telling us in 2 years' time where they're going to raise interest rates to. But what have we seen? We've seen those expectations change dramatically as yields have shot up. So now, while the beginning of the year seemed kind of somewhat calm, and so now those rates are really reflective more of where the Fed is going to take interest rates. That's been interesting, to say the least. So there's been a major adjustment in market expectations and probably a lot more concerns about where this could go. Where would the Fed continue to go? What's been interesting, just as an example, the European Central Bank has been doing something similar. They're tapering right now, and that should end at the end of this year. The question is, when does the European Central Bank raise interest rates? Most of the market expectations aren't till mid-2019. And today, yesterday, adding to the uncertainty with the European Central Bank, they said, we're going to keep doing this, but we're not so sure about the economy. It seems a little bit slower for some reason. That adds to the narrative that's out there that things aren't good, right? That things are kind of tumbling along, and it certainly, engenders more uncertainty about what they're going to do. So just kind of, I know this is a little strange, but just it's kind of fun to take a look at how market expectations and the Fed go in very different directions at times. All right. That said, let me continue to move on if I can slide. Come on, let's go. There it is. So I talked about 2-year note rates, right? This slide's really busy. It's from Bloomberg, but this is the world bond page for 2-year interest rates notes from government securities. What I just want to point out is at the very top on the left is the U.S. Obviously it's the U.S. 2-year note. It was at 290. On Monday. It's up 132 basis points on Monday it was, in 1 year's time. That is a big move. That is a huge move. And so that's injected, when you have that much volatility, that much, moving forward in interest rates that quickly, it's going to permeate out in a lot of different ways into the cost of money, and then also into businesses as they try to predict out what's going to happen. Right? It certainly makes it, they have to go back and recalibrate what are their discounted cash flows for the projects that they're working on. How does that look? How do they raise capital? Does it cost them more money? Is that going to take away from their profits? If